Welcome to the 14th episode of Dividend Investing Insights, your one stop for all things dividend investing. Join us as we explore tips and techniques to maximize your dividends one dividend at a time. In the episode today, we'll continue to look at the portfolio that we have been building for the past few weeks and see if we can make more buys in our portfolio and also look at the performance of the portfolio that we have been holding for a few weeks now. However, like always, let's start with the performance of the markets. S&P 500 in the last 1 week fell by 49.7 points to end at 5,808 points. Nasdaq gained a little by 62 points to end at 18,518 points. And here locally in Australia, ASX also fell down by 72.5 points to end at 8,211 points. But as I have said many times before, the stock markets and share prices will go up and down all the time. However, you as an investor should look at stocks that are fundamentally strong and have the ability to pay dividend in the current year and continue to pay dividend in the years to come. Let's get on with the episode. Now, we had started building a portfolio. Let's look at just do a quick recap of what all we have bought. The first stock that we had bought was KDP. We had bought 50 stocks at 37.46 for an investment of 1,873. It had a dividend date close to the time of buy. The next one that we had bought was JP Morgan Chase. We had bought 10 shares at 2010.5 for an investment of $2,105. We have met the ex-dividend date of this as well. The payout date is close by. Then we had bought AT&T 100 shares at 21.91. Again, the payout date is close by. And then last week, we had bought CVS Health. CVS Health, we had bought 30 shares at the price of 60.34 for a total investment of 1,810. A quick reminder, the ex-dividend date for CVS Health was 21st October. It was paying 66.5 cents per share on 1st November 2024. Now, as always, let's look at, as a practice we have been following, whenever we have to make an investment, we look at the upcoming dividends and see if there's any share that is good, that could give us a dividend in the short while, and at the same time being fundamentally strong, which means that passing all the parameters in our dividend investing checklist. So in this scan of the calendar, I come across a big giant, Levi Strauss and Company, with a ticker symbol Levi. Most of you viewers would have worn any of the Levi apparels. Not only do they make clothes, but they also make accessories for both men and women, a global brand, and into existence for maybe somewhere in 800s. As of this recording, it has a market price of 17.48%, has an ex-dividend date of 29th of October when it's paying out 13 cents per share, and it's paying on with a pay date of 14th of November. Now, let us look at Levi Strauss and see whether it passes the dividend investing checklist test. Here's the checklist. Do you understand the company's business? What is the dividend yield? What is the average dividend for the past 5 years? What is the payout ratio? What is the price to earnings ratio? What is the price to book ratio? Does the company have year-on-year revenue growth? Does the company have year-on-year profit growth? And does the company have positive cash flow? So we look at all of these parameters. Let's put it in rather than going one at a time. So yes, we understand the business of the company. The dividend yield is 2.86%, and for the year 2024 is paying out 0.5 cents, 50 cents for the year, giving a dividend yield of 2.86. Average dividend yield for the past 5 years is 29.8 cents. So while the dividend is increasing, but what I did notice is during COVID, probably the sales had fell significantly where it could not pay the dividend, which has brought the average down. Otherwise, for the past 2 years, it has been paying a little less than 50 cents. It has been growing its dividend, but this is the absolute number. What is the payout ratio? The payout ratio is an astounding 128.95%. This is not good. This is way more what our range of 30 to 70% is. Price to earning ratio is good at 11.31, is well in the range what we look at. The price to book ratio is a little bit higher. Ideally, we want it to be in the range of between 1 and 3. This is higher at 3.7. Company year-on-year growth, I saw the fund financials and appear to be relatively flat, um, ranging from for the past 6 or 7 quarters. The per quarter revenue was between 1.4 billion to 1.6 billion. The last quarter of the year, where we have the Christmas and New Year break, it goes up to 1.6. For the other quarters, it stays between 1.4 and 1.5. So revenue is flat. Does the company have year-on-year profit growth? Again, relatively flat, stays between 11 and 13%, with some exceptions in some quarters, but majorly between 11 and 13%. And does the company have positive cash flow? Yes, it does, which is a very good sign. So it's not borrowing money to run its business. So it does have positive cash flow. Now, looking at the data, the payout ratio is certainly not a good sign. 128% means that it is taking money from the market to pay out its investors. It's not a good sign. Price to book ratio 3.7, no revenue growth. All of this does not make a good sign and makes it a no buy for us. So we would not be buying this share, which means that there is no other share that we see is worth getting into our portfolio. So we look at the dividends that are coming in the next week, or anything that we feel is useful for us. So there's no, we are not buying anything for this week. And let's do a quick recap of our portfolio as to how our portfolio stands from a week to week basis. Again, the first share, KDP, we had bought at 37.46. As of this recording, the price has fell to 34.58, making it a portfolio of 1729. And this is an indication most of the markets around the world are slowing down. So, which is why this is reflective over here as well. JP Morgan Chase, JP Morgan Chase, is moving in the right direction. It is increasing. Um, and the as of this recording, the price was 222.31, making it a profitable investment for us. Well, that's not the decision at all. AT&T, AT&T is also near the buy price. We had bought at 21.91. It is currently at 21.83. Last one, CVS Health 60.34 and has fallen to 56.49. This is very interesting, and many a time when the dividend payout is close, share prices go up because people are trying to capture the dividend, which is a similar strategy that we are adopting. However, since the company is fundamentally strong, we need not worry. This will bounce back up. Collectively, an investment of 779.79 has fallen to 7829. Viewers would remember last week we were well in the positive. This week we have gone down, but that's not all. We also have a cash of 11.5. This is the dividend that we had got from KDP. So not an alarming situation. The market has dipped due to some of the geopolitical situation. The American elections are coming up. There is war in the Middle East. There's war in the Ukraine. All of this affects the market. But till the time the company is fundamentally strong, you as an investor can be assured of a good dividend, which we'll see as we progress through the episodes. Before we end, a quick recap of what dividends are coming our way. There are three dividends that are coming our way in the coming week. JP Morgan Pays will be paying out $1.25 per share. AT&T will be paying out 27.75 cents per share, and CVS Health will be paying 66.5 cents per share. So, well, that's the end of the episode. Ending the episode again, putting up the checklist again, use it to make your investment. And thank you for watching. And look forward to meeting you in another episode of Dividend Investing Insights.